Hello and welcome to Business Today. I'm Siddharth Zarabi and we are at the Business Today Best Banks 30th anniversary jury meeting. The jury has finished its deliberations and the results will come out at the BT Best Banks Awards event at the end of February. But today, with this esteemed panel, we are going to discuss the state of India's banking system and also a bit about where we stand as far as the economy is concerned in 2026. And I have great pleasure in introducing my jury here with me today. To my right, Mr. Dinesh Kumar Khara, the former chairman of the State Bank of India, former winner of this award. He's chairing the jury meeting this time. And coming to you, sir, to get this discussion started, tell our viewers about where does the Indian banking systems stand today? Many years ago, the headlines used to be mostly negative. We were talking about the NPA crisis, but over the recent past, India and its banking system have demonstrated resilience, obviously on account of the efforts of multiple people involved. Describe the state of banking in India at the top of 2026.
Thank you very much, first of all, for having me over here. Well, when it comes to the banking system in the country, we are very proud of it in terms of the capital availability, in terms of their adoption to the technology, in terms of the risk management. Part of it, of course, is a learning from what we had experienced in 2008, 2014. But yes, of course, those learnings have been well institutionalized, and based upon that, the risk models have been tweaked, underwriting practices have been improved, and also the greater adoption of technology and also the AI has actually made the life much easier for the bankers in terms of their credit assessment, in terms of their ability to serve the customers. I think when it comes to the regulatory environment also, I would say that it is pro-growth and it is quite encouraging. Looking at the opportunity which is there in this sector, we are seeing a lot of interest from the global investors. We have already seen that ENBD has committed itself into a bank in the country. Similarly, when it comes to the MUFG also has also committed themselves into a NBFC. SMBC likewise from Japan, they have committed themselves into a bank in India. So I think that's a very clear reflection that they are perceiving a good opportunity of growth for the banking system in the country, and rightly so, because when it comes to the consumption loans and the retail loans, the opportunity is huge. It is, as of now, it is about 42% of the balance sheets, retail balance sheets. But if we look at the developed nations, the opportunity is huge. And also a very significant middle class, which has got aspirations and ambitions. They are the ones who are borrowing. Fortunately, with the help of technology, banks are in a position to have better credit assessments of the retail borrowings also. So I think all said and done, be it corporate, the resolution mechanism is very well oiled, and we have seen that the corporates have got sufficient cash in their balance sheets, and they're in a position to invest into their requirements, and that is one of the reasons why the corporate borrowing was not seen as strong in the past. But retail borrowing has actually taken the role. They've actually moved into, and that gave an opportunity to the banks. Only one challenge which people keep on talking about is relating to the deposit, because what we are observing is the loan growth is significantly higher, and hopefully it will stay like this for in the foreseeable future. Credit deposit ratios have moved almost worse in the range of about 81-82%. So at this point of time, the challenge is essentially in terms of the deposit accretion. So, but yes, of course, banks are today facing competition from the alternate investment options which are there in the market. I think banks will have to probably work in terms of improving their operating efficiency to really protect their NIMs. Banks will have to probably look at the ways through which they can garner the deposit. Maybe the deposit raising through various instruments like bonds, etc., will gain greater currency in the days to come as compared to retail. But yes, of course, I think it's a very interesting scenario which is there to unfold. And but banks are prepared to really handle all such opportunities and deal with the situations.
Thank you for that overview and summary. I want to go across to Ashima Goyal, Professor Emeritus at IGIDR. The point about credit to deposit ratio that has been made by Mr. Khara, ma'am, is this a cyclical phenomenon, or do you think it's a macro-prudential concern?
I think it is cyclical. We are seeing a pickup in growth. At the same time, interest rates are coming down. But I think banks will find that they need to make sure that their NIMs are maintained without passing through a rate rise to depositors as much. And banks have the scope, as Mr. Khara was saying, to improve operational efficiency, to adjust their portfolio accordingly so that they can reward depositors and attract more depositors. And this is something that, it's not lazy banking. They have to sort of pull up their socks and perform. And the other advantage in India is that we have a diversified financial sector. The way banks have contracted in the US, we still, and because we have very heterogeneous society, some people, their first bank account, no frilled account. So banks remain very, very important in our financial system. But the trouble they got into over the last decade was because they were forced to lend to infrastructure where there's a set liability mismatch. So we've seen much more development in markets, and even the bond market has, so to that extent, the pressure on banks is less. The asset quality has improved. Therefore, also they have room to absorb, to sort of pass on better returns to households without necessarily, and because we saw a lot of banks really worrying about rate cuts, regulatory rate cuts coming in, because they felt that deposits, they didn't want rate cuts, and they were worried about the impact on their profitability. But we saw bank profitability continues to be very good. So that means they have enough levers to adjust, to sustain their profitability and give better returns to households, to attract depositors.
Absolutely. Let me go across to Zarin Daruwala, Group CEO of PL Capital. Zarin, I don't know if you want to add to the previous comments. What I also wanted to ask you was, is there a risk that the markets, according to you, are not factoring in or perhaps underpricing when it comes to the Indian banking systems? Because sometimes the markets get ahead of themselves and go into a sort of bullish, optimistic phase. So add to what the previous speakers have said and also on this risk element.
So you feel that the risk is not getting priced appropriately?
That's the point. That do you think it's not being priced appropriately?
I would not say it's, I think it's of course, a competitive environment, but I would say risk is getting priced appropriately. I think to just supplement what has been said, I think the big growth which will come will be in the MSME lending, because there's more and more formalization of the sector that is happening. Of course, NBFCs will give fierce competition to banks, but at the same time, the sheer availability of data, whether it's GST or many other ways you can triangulate the data, that really improves your credit lending quality or assessment. If you look at the data on MSME lending more than 2 to 5 crore to 100 crore, the NPA ratios have come off quite substantially and they're quite low. And the margin that you can sort of charge is quite decent. So you are able to do risk-adjusted pricing quite well. I think for the banks, what has happened is if you take the BSE 500 companies, literally the debt equity ratios come down below 0.4. So, and very little borrowing is happening because their own internal cash generation is actually sort of funding a lot of their capex, etc. And they are also accessing the NCD market. So I think for banks, the corporate lending is obviously moving to the medium sector and the small sector in a bigger way. The growth will come much more in terms of growth rate from there. The other thing I would say is that the global uncertainty continues to obviously weigh in terms of, for credit quality, suddenly you have some tariff and it affects the textile sector. So those uncertainties will play out even in 2026. And the sectors which I think will really take up a lot of borrowings is power, capital goods, defense, chemicals. These are few sectors where I see a lot of credit growth happening.
The defense theme is definitely playing out. There are 4 other stalwarts on this panel that I'll come to, but Mr. Bajpai, I'll start with you as in your capacity as former chairman of SEBI and LIC, and in your current role as well. You know, we have attempted over the years, not just recently, multiple cleanups of our banking system because it is a cyclical industry. Would you say that India has genuinely fixed the governance aspect of its banking system, and do you think that it's being done through all stakeholders involvement, or it's just heavy hitting by the regulator?
Well, thank you very much for inviting me, and let me mention to you here that banking sector, as Mr. Khara said, has done a great job in the last couple of years. Not only cleaning up the balance sheet, but also setting up the systems, processes, and technology. Having said that, governance is not a static situation. It's a moving piece. And governance of an institution moves along with times. Because when the new risks come, the governance has to take care that those risks do not start playing up on the balance sheets. Now, having said that, let me tell you why I'm saying so. First and foremost is that the entire financial sector is in for a massive disruption. It's not only a question of Bitcoin coming in or tokenization happening. It's fundamentally, for example, the lending institutions, particularly the banks. They are pharmacy of liabilities. And as he said, the assets has to undergo a different frame altogether. See, I have done a small study. According to me, the savings and investment pattern in India has changed forever.
Forever?
Yeah, it's not going to come back. That people will put their monies into fixed deposits. People will put their large monies into fixed income securities. It's bound to happen. You can see, notwithstanding the kind of upheavals that are happening in the marketplace, and it is not the big people with big monies who are investing into SIPs or otherwise. These are small money from small towns and villages, and people are getting educated. And fortunately for them, social media has done a great job educating the people about the financial market.
I would also say that perhaps miseducating also.
No, the second part is, as she said, the lending or the asset creation also will undergo change. Earlier, financial institutions were used to the luxury, she said, lazy banking, 4% NIM. Now, you are not going to have that. And therefore, the organization design itself has to undergo change.
So fundamental changes and challenges on top of us. Ashish Chauhan, I want to take this point about banking changing forever, the days of everything going into fixed deposits. But the question to you as MD and CEO of National Stock Exchanges, what can the capital markets do to meaningfully share the burden further on the banking system to fuel India's growth? What are the structural reforms that you think are required from your perspective?
I mean, there are many sort of things that have been discussed. I agree with, I think, all of them. The way I look at it is today, the banking system size compared to the size of the economy is much lower in India compared to similar size of economies. For whatever reason, we are what I call the least leveraged large economy in the world. Now, in one of my earlier sort of interactions, I had said that now we need to probably give incentive to lend. Somehow we became too tight and we made it too much of disincentive in terms of lending. That
when you say incentive to lend, you mean incentives to the lenders?
Yeah, basically the problem is we were so tight and the managers got affected mentally also, that they now don't want to lend only because of whatever happened to some of them and things like that. So that's where I think we need to, what she described as lazy banking. But for me, the other side...
You are hinting towards the consequences of phone banking. But please continue your point.
So, the other side which I look at is, what do the savers want, right? We need to worry about savers. Currently, we seem to worry about banks. So savers what do they want? They want better returns compared to other assets like say equities or gold or real estate. And when they had no choice, it was okay that they would put their money in FD, and I think CASA was mentioned that as a great achievement of somebody. But for me, now with mobile, everything is fluid. So people are able to shift things in a few seconds, if not faster. And that's where, for me, people chase past returns. And if you look at, say, Nifty was 1995, November 3, that is pretty much 1996, 1st January. We are sitting in January 26. So 31 years back, it was 1,000. Now it's 26,000 with all ups and downs. And if you take the dividends, it would have been probably 32,000. So 1,000 has got you 32,000. If you sell it after tax, it will be still more than 26,000 or something after 15%. Whereas if you had put your money in FD, it would be probably 1/5 or something, right? So that's why I'm saying people now are comparing all those things. They are getting, as you rightly said, the influencers or social media is making them aware. And naturally, everyone wants more returns out of their savings. Some might fail. Some might also get taken to cleaners. But broadly, why I'm telling you this is, unless the banks start learning to give better returns comparable to other assets, it's going to be very difficult. As I said, the savings pattern has changed decisively because of the automation and Jan Dhan Aadhaar mobile, as I would put it.
Right. The two jury members who are yet to speak, Mr. Surojit Shome, former MD and CEO of DBS Bank in India. I'll come to you and then to Gunit Chadha. And if time permits, 2-3 minutes, I want to ask a question about fintech and technology impact. But Mr. Shome, India leads, according to most accounts, the world in digital payments. Volume, clearly. But are banks being able to actually monetize this or simply absorbing the costs, a kind of Jan Seva that...
So I think earlier, thank you for having me part of the jury, but we discussed this earlier today, and payments is really a part of the infrastructure. It's table stakes. So you cannot think about a business model where you make money off the table stakes, correct? You have to add something more. So you have to take the rails or the benefits of digitization and create customer value. And that's where banks have to move. And to add to earlier points, I think lazy banking or the way banks were doing business, we were warehousing all the risk. If you warehouse all the risk, the chances are you need much higher margins. But if you look at banking sector as a whole, has an intermediary role. And the efficiency of intermediation is the job of the banker. And that role of intermediation is changing. Because of digitization, because of how our balance sheets should migrate, how we package risk and not hold it for life. That's the role of the capital markets has to play. If you look at companies, when they grow, they mostly do not borrow from banks. So they go to the capital markets, which means you have to play a role in the middle of the economy, whether it's SMEs, whether it's individuals. And that's where data, technology, discoverability will really make banks nimble. People who don't move with this channel will suffer and potentially will not be there 5-10 years from now. So I think the whole industry of banking and financial services is undergoing massive disruption, and there is an opportunity to harness that and get ahead of it. If you follow this or behind the 8 ball, as the cricket will say, you will lose.
Absolutely. Gunit, I want to come to you as former CEO of Deutsche Bank, and the jury did during its deliberations come to this point, but that's off record. The question I want to really ask you is that there have been significant regulatory changes, particularly in the last few years. The last 1 year has also been quite a momentous one when it comes to overall regulation. Is India's banking and financial services regulatory framework enabling global competitiveness of our banking system, or is it still limiting growth, especially outside India?
So just a couple of comments which probably play into that theme. Firstly, let's recognize, even today, as was 25 years ago, JP Morgan, Citibank, Goldman Sachs stay well in existence and more, okay? And it's my belief that while individual members in the banking system may change, but as a whole, the banking system will reinvent itself so it stays very, very relevant to country's economic growth and that of many of its savers and lenders. What we've also seen over the last few years is that the government has taken many pro-growth steps. The regulator has taken many pro-growth steps, which I think is exceedingly important for banking to reach into the bottom of the pyramid. And a comment on the bottom of the pyramid, the NBFCs, which is what in many ways I represent, that's where my current life is in its current avatar. I think NBFCs which are focused at the bottom of the pyramid, at the MSMEs right there, what is an obligation for banks to do in terms of priority sector is actually a business opportunity for many of the NBFCs to do, right? And if you put that lens, it completely changes how you approach that opportunity.
So for the average listener, is your argument that perhaps for Indian banks, the need and the scope and opportunity is to service India fully rather than look overseas at this point of time?
100%. There is absolutely no doubt in my mind that rather than having capital trapped overseas, which actually Indian banks don't have right now, in a very limited way, the biggest opportunity is right here. And the biggest opportunities to go rural, the biggest opportunities to go into the micro SMEs, and the biggest opportunities to partner with other market participants, whether it's the value-added service providers, whether it's the NBFCs, which even now I've seen the government giving much more priority to. And I stay extremely positive in what this space will offer into the future. And the greater the competition, frankly, the better it is for the whole system.
Absolutely. There is so much, viewers, to discuss on a subject like this, but I'm out of time. I'll request the panel 30 seconds of a point unless there are any follow-ups. And this is a question which again was discussed by the jury in a different context, but I want to frame a question around it and I'll request anyone in the panel to. Will fintechs and big tech ultimately strengthen our banks, or will they play a role in hollowing them out, as we have seen technology impact many other sectors? I throw this question open to the panel for quick comment.
It will depend on the institutions. If they are able to harness the better part of the technology, they will prosper, they will thrive. If they are not able to meet the challenge of that, then there is a journey down the hill.
I would rather say that, when it comes to fintech and big tech, I think banks can consume the services offered by them, and it will be a win-win for both, because when it comes to fintech and big tech, their comprehension of the regulatory environment and to deal with the regulatory environment is rather very minimal. So as compared to that, banks are regulated entities, financial sector being a regulated entity, they can consume their services. So I think there is a scope for both to really grow well.
Yes, absolutely. I think we need to make a distinction between a static cake and dividing it among different participants. And you say more participants have come in, each will get less, and a growing cake. So we have a growing cake in India, and there are opportunities for everybody. The other thing about the market is specialization. You specialize in one thing. It's the division of labor, and you become more efficient at that. And then you partner with others who can do jobs you were doing earlier, and the whole economy benefits.
Go ahead, Gunit.
I think fintechs and the value-added services will most definitively help the banking system in crush the operating costs, in lowering the credit costs, and transferring significant value to the end customer. And that will only be good for everyone, right?
So maybe just to add another perspective, every innovation that has happened, there are people who build the rails, then people who build businesses on that, and finally people who change their business model completely around the new technology. Parts of our industry who do the last will definitely benefit.
Okay, Zarin, and then finally Mr. Chauhan.
Yeah, I think there's a place for both to coexist. And as Mr. Khara said, I think as banks, we've all worked with fintechs, derived the value of what they offer, and improvised our offering to the end customer. So they've built the rails. A lot of them, the payment architecture has been built on UPI by many fintechs, and the banks have been also using those services. So to my mind, both will coexist.
Mr. Chauhan, the last word to you.
I think it's the new reality. It was like a combination of many services banks were providing. Now people are taking small L chunks and providing better, faster, lower cost services, and whoever combines the best. The other side is that the distribution, like in big tech, Google has a much larger chance because distribution is the king. And in India, financial services, the distribution comes out of the banking system. So and of course the trust of people, right? So if you combine these two and continue to build more tech, then people will come back to the banking. And so people who, as everyone has said, if they don't build on that, then naturally the other competition is going to come. But that one of them is also the stock markets. Today, for last several years, the net credit to industry and services, net incremental credit, is now more from the markets rather than banking system. So that's actually showing you how slowly people are directly borrowing from the individuals using markets rather than via banks where some kind of costs get added.
Viewers, what I picked up from this short but very informative discussion is that the world is in flux. We all know that 2026 is expected to be the same. But clearly, perhaps one of the learnings is Atmanirbhar banking, serving the needs of India's vast population, growing there, rather than perhaps looking at metrics as to which bank from India stands where in the global ranking. That too is important, but servicing and fulfilling the needs of the Indian customer is, and many on this panel have done that for their career, and they've spent quality time with us to recognize some of the best institutions in this space. So I thank all of you once again for that, and you, the viewer. We'll be back with that special awards event at the end of February. Until then, goodbye.